In this week's update, don't let short-term volatility blind you to where markets are going. Opportunity time is getting closer, and the rampaging US dollar punches commodities. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Right, another volatile week. Plenty of fear around the place, that's for sure, and wise people have always said that you've got to learn from past events. And if we look at what happened around COVID, if we look at what happened in 2022, where US tech stocks went down for 12 months, and if we look at what happened in 2025 around the trade tariffs, what can we learn from that? Because there was certainly some great lessons. The first one is that great investments, quality stocks with great growth rates and high probability of achieving them, that have also got long-term tailwinds, they bounce back very, very strongly. And they start bouncing back sooner than just about every other part of the market. The second lesson is that whilst it's an enticing thought, jumping out of the way, selling some of your best stocks with the intention of getting back in at a lower price is actually incredibly difficult to do. So it's a nice thought, but it doesn't really work very well. The next lesson is that the crash, if indeed we do end up with a crash because of all of this fear over what's happening with the Iran war, it can get to levels that can be really concerning for investors. And we saw with COVID, it only lasted a month in terms of the impact on the stock market, but the crash was very severe indeed. So that can be extremely disruptive for investors. Most investors start with solid long-term intentions. They're going to hold the quality stocks, but as things get further and further into the process of the correction, or ultimately a crash, if that's what it is, then emotions come into play and they end up selling near the bottom. And I'm sure most people who are watching this video can identify with that scenario. So if you're going to sell, then get it done early to create attack capital. For some, you need to do it because the psychological pressure is more than what you can stand. And if that's who you are, then that's absolutely fine. For others, it might be just a straight out strategic move to create some attack capital for use when the market gets to the bottom. So it's really important to understand what type of investor you are. And that's why listening to tips from others is such a wasted effort, because those tips take absolutely no account of what your psychology is like and who you are as an investor. What is happening at the moment, and I know a lot of people might struggle to grasp this concept, but what is happening at the moment is actually pretty good, because we've got 6 to 8 really unstoppable megatrends, depending on how one defines them. And we're now getting the opportunity within those megatrends to buy stocks at prices that not only are significantly lower than what has been available for the last year or two, but also we've now got the benefit of hindsight. These companies have evolved. They've moved on. We know how well they're doing. But now all of a sudden, the prices are not where they were. They're much cheaper. So it all depends on how you think about it. So you need to stop being concerned about what's happening and see it as an opportunity, see it as a potentially good event, because disruption always throws up fabulous opportunities. So just coming back to the mega trends that I spoke about before, which of these following trends will not be far stronger and probably far higher in 1 to 2 years' time? If you look at precious metals, we've got out of control debt. We've got a process of de-dollarization that's not going to stop no matter what is happening around the world. We've seen enormous shifts in the way that trade is being done. So it's hard to see that precious metals, the drivers of precious metals to higher levels, is not going to continue. If you think about robotics, the proliferation of robotics, which again is an unstoppable trend that is not going to be impeded by global growth or the war in the Middle East, it's going to require massive amounts of commodities of all sorts, and particularly specialty commodities. If you look at defence spending, there are national security imperatives with just about all countries around the world. If you think about the energy to power the AI revolution, and also it's a national security event as well. And then finally, the energy infrastructure around data centers and all the transmission mechanisms. Tell me which one of those trends is not going to be miles stronger. So therefore, the best stocks in each of those sectors are going to be doing far better in a year or two's time. And if we look at GDX on the Aussie index, just to show that there are opportunities, and this is typical of many Australian producers, it doesn't make a lot of sense that we've got an Australian gold producer with first half production just announced up 58% period on period at an all-in sustaining cost of about $2,500 an ounce. We've got revenue up 142% from the previous period. We've got the EBITDA up 172% and the net profit up 400% from the previous corresponding half year. Operating cash flow has enabled repayment of $100 million of corporate debt facility, so this company now has no debt. They've got $400 million in cash. They're on track to achieve their FY26 production guidance. And on top of that, they've got some very strong long-term growth options. And yet this stock trades on an FY27 PE multiple, which is what the market is factoring in, of only 10 times. And if you look at the earnings growth rate, in FY24, they did 7.2 cents a share in earnings. In FY27, the forecast is 62 cents, almost 10 times across those 3 years, and yet it trades on a PE multiple of only 10. And it's producing bucket loads of free cash flow. So it makes no sense for stocks like that to be getting sold off, as we've seen in the last couple of weeks. Yet that's what's happening because of fear and panic in the market. So we just need to be nimble, we need to be flexible, we need to be aware, and that is the essential message from the video this week, that what is happening, if you approach it the right way, is nothing to really be concerned about. It's an opportunity to be grasped. But for most investors, you probably need to think about it differently to what you have in the past. You definitely need to lose the tendency to feel like you've got to be proven right. This is just about protecting capital and making money. That's what investing today is all about. So be on alert for the lowest risk way to operate, whatever that is appropriate for you. Hold on to your high conviction core stocks, or hold on to a decent slab of them. You might want to trim a little bit, but work with the current momentum with everything else. And really, you should be selling the stocks that don't have upward momentum and holding onto the stocks that do have upward momentum, whereas most investors tend to sell their winners to ensure that they keep that profit. It's just the wrong way to go about it. It's the wrong way to think about it. And of course, as always, we advise that before you do any investing in the market, that you get all the investment and financial or legal advice that you require. Now, if we look at the American market, the S&P was down 1.6% for the week, and the Nasdaq was down by 1.3% for the week. So that tells you it wasn't necessarily a disaster for tech stocks. And the semiconductor index SMH, or the ETF, I should say, was steady on the week. So that's still holding up very nicely. The Russell 2000 was down about 1.7. So everything was down around about that 1.5%. So there was a lot of fear in the market, but it wasn't a disastrous week, not in America anyway. And the basic story was that we had energy up and the rest was down. And that's pretty much the summary of what happened in America and also in Australia last week. And the US dollar index gained very sharply, went over 100 and closed at 100.5. And so that's certainly pressured commodities. The 10-year yield, which was down under 4 just a couple of weeks ago, is now up to almost 4.3. So it's been a very sharp move. And the VIX index is still holding in that 25 to 30 area, which is obviously a sign of the fear that's in the market. Let me just go back to the chart that I was showing before, because a lot of these, what the indices are doing is really irrelevant from my perspective. Because if the index is looking like it's going to break down, then what does it matter if you own stocks that look like this, that have been trending very, very strongly and are consolidating high, so not very far off their all-time highs, hardly any retracement at all, or that look like this, and there's hundreds and hundreds of US stocks that look like this. So that's why you don't want to go selling your winners when we get into a period like this, because it just feels more comfortable to take profit than it does to take losses. But that thinking is completely upside down. So let's look at the US indices. We'll start with the NASDAQ composite. And this is on a weekly chart. You can see we're approaching an important support level from an index point of view. But from my point of view, I'm not really too fussed whether this support level holds or not. And if we put it on a daily chart, you can see certainly Thursday and Friday, we saw some accelerated selling. And if we go to SMH, then that held up pretty well, down just a fraction for the week. But looked at on a sector basis, energy continued to roar higher, but everything else was heading in the downward direction. And the Australian market, it looks very, very similar. So we've seen some very sharp selling in the materials index. And it was only really a bit of stability in the banks that protected our index at all. The S&P, from a technical perspective, it looks like it's starting to break important key support levels. This is on a weekly chart. If you put it on the daily, which I'll do in a minute, you can see there are lower highs and lower lows. So what would be a good level to look out for to potentially cash up on the index? And this was a question that I had last week and I answered last week. And I'll just repeat the answer that I gave. And that is that I'm less concerned about what happens with the index and more concerned with the trends of what it is that I own. So let's look at currencies now. So the US dollar shot up very, very sharply. You can see closed at a high, and we've got to go back really to about May of last year. So almost a new 12 months high. And this is probably going to continue while the war in the Middle East is continuing on as it is at the moment. The Australian dollar, I would have thought, was entitled to have fallen much further. So that's a little bit surprising, the strength, relative strength in the Australian dollar relative to the US. Moving on now to the Australian index, and you can see we're sitting on key support here on the Australian index. But again, this is even more irrelevant from my perspective to be using as a timing tool, because it really just reflects the top 10 stocks. So summarising for the Aussie market, the Aussie dollar finished at 69 and a quarter, and the Aussie index was down 2.65% for the week. And I would expect that we'll probably see that extended on Monday with the negative finish that we had in the US on Friday night. So it finishes an obvious support, but unless you own pretty much just the top 10, it really doesn't matter. And also in Australia, we've got a situation now where we can probably expect multiple interest rate rises, which is going to be a negative impact, not only on the economy, but also on the cost of living. So things aren't looking all that rosy in Australia. Precious metals, gold was down 0.9% for the week, still holding above 5,000. In Aussie dollars, we slipped a little, but still holding well above the 7,000 level. Silver was at $80.50. It was down 5%. But as we'll see on the charts, this is all just part of consolidation, and the main trend is still very much to the upside and will be for most of the next decade. It'll be volatile, and that really is the price of admission for what the precious metals sector has to offer. But there's no doubts in my mind that we're going to see a very extended period, and if history is any guide, it's going to be something of the order of a decade, and we're only a couple of years in to this bull market in precious metals. It's important for you to understand what are the sort of stocks that are suitable for you. And if we look at the precious metals area as one example, then you've got a choice between existing producers, advanced developers, early stage explorers, or even doing it via an ETF. So before you go buying anything, you really need to understand what that mix is that is best suited for what you're trying to achieve and what your psychology can deal with. GDX on the ASX was down 3.35% for the week. GDXJ listed in America was down 9%. So a lot more of that happened on Friday night. It was a fairly nasty session for gold stocks in America on Friday night. So I would expect that our gold sector should open pretty negatively on Monday morning. NSILJ was down 7.5%, which is the silver listed companies. Most of those are producers, even though it does have the J for juniors attached to it. A lot of them are still existing producers. So let's go over some charts around the precious metals sector. We'll start with silver. This is on a weekly chart, so you can see this is still a very volatile, but still a consolidation that's forming up in a triangle pattern. And this is what I was showing last week. So I'll just move these a little bit. So the triangle is still in play. So we've still got this triangle, which is forming up. And with triangles, the breakout tends to be in the direction of the original move. So the original move, obviously, very clearly to the upside. And at this point in time, that's still looking like the direction that it's going to move in. And similarly with the gold price on a daily chart as well. And we're seeing it also with the miners. In Australian dollars, it's still looking a very, very strong trend for the Australian dollar gold price. Turning now to other commodities. Copper fell to 5.63, and I just can't help wondering about whether this is a rerun of what we saw in uranium, which really from 2019 looked like an absolute no-brainer in terms of the supply and demand balance. But the market didn't really get interested and start pricing in higher uranium for quite a few years. And I'm just wondering, copper has been looking like it's an absolute no-brainer for several years now, but it's still not really moving in the way that the future looks like it's going to unfold. Anyway, we shall see. West Texas Intermediate crude finished just a touch under 100. Brent crude obviously over 100. And this has been the highest spike since the Ukraine invasion in 2022. And we'll look at the 10-year chart on crude in just a minute. This massive disruption to the oil supply lines and the price spikes is bad for the world, just in so many respects. But it's also really bad for us, and all our politicians of all persuasions should be ashamed of the position that we now find ourselves in, where we should have a 90-day fuel buffer, and it's apparently down to something like 30. And that has been allowed to happen despite decisions that were made 10 or 15 years ago. So it's a particularly difficult situation for Australia if this war continues for a few more weeks or more. There's the copper price. So we're back now. We've got lower highs, lower lows, and we're getting back to where we were at the start of 2026. And there's the huge spike in crude oil over the last couple of weeks from under 60 to now being at 100. So that's been a massive spike. And just to show, this was the Ukraine situation. So there's been only one spike in the last decade that goes higher than where we are now. So wrapping things up, the final message is that this phase will be broadly predictable, not in terms of the nitty-gritty specifics, but broadly predictable because it's being driven by psychology, and psychology at the extremes is extremely predictable. So you've just got to have the ability to step back and look at the market, where it's going long term. Don't be fixated on what the market's doing at the moment. You really should be taking account of where the market is heading over the next 6 months, 12 months, 5 years, and work from there. This current market is presenting what I would call buy of the year opportunities in their absolute hundreds. And that's the way you need to be seeing the market. But those benefits can only be accessed with clear planning and with a continually refreshed perspectives as events unfold. And they're unfolding very, very quickly at the moment. So extremely unpredictable. And as I said earlier, it's just so important to be working with the current momentum. It's absolutely vital that the bulk of your portfolio are on stocks that are either still rising or are holding at a relatively high level, ready to resume an uptrend once this phase passes. And just basically pay attention to the basics. Try and not get too fearful about what's going on. Pay attention to the good, solid basics of investing. So that's all from me this week. I'll be back with you next Sunday. Cheers.